I'm getting this feeling that we're really close. Maybe it might be AI just creeping up, and people just thinking less and less and less, and the frequency of actual independent human thought getting farther out and less frequent. So as I see, I don't think the human spirit's going to die, but I don't think that we can survive in a world of AI. So I think this all has to end pretty soon before we lose our minds.
Rafi Farber warns the financial system may hit a breaking point within weeks or months. SOFR lending has swelled to $3.2 trillion, akin to pre-2019 repo stress. Banks avoid Fed repos to hide weakness, and interbank rates exceed Fed repo rates. He argues an inflationary spiral forces more inflation to avoid bank collapse, using Japan as an example where policy lost normal effects. Farber predicts hyperinflation is likely. Gold, possibly $60,000 to $80,000. A short period where only physical gold, silver buys essentials. Then a gradual return to sound money and decentralized credit. Any shock could topple the interconnected dollar fiat system. Thanks for watching. Subscribe to Fine Metal for more updates.
There's a few things that I'm tracking. I always track the plumbing first, and then I see if it's affecting other things. So what I mean by the plumbing, those who have followed me probably know what I'm talking about. The interest rates, that is the basis of all other interest rates. That's the secured overnight financing rate, the rate at which banks charge each other to loan cash in exchange for treasuries overnight. That's it's heading higher and higher and high. It's drifting higher, even higher on some days than the Fed's upper limit on the Fed funds rate. The Fed funds rate is like a different thing. It's a very minor market. It doesn't even matter anymore. It's like the volume there is like $100 billion a day at most, whereas the secured overnight financing market is like over $3 trillion. So the largest volume has been $3.2 trillion. And it keeps going up, the volume, which means more and more banks need money overnight for whatever reasons that it is. I mean, it's probably a lot of the bank's clients are engaged in some kind of basis trade on whatever treasuries, and it keeps getting bigger and bigger. And if they can't provide the dollars, then those trades have to close. But basically, the Fed is in a bind now because eventually this is going to lock up pretty soon. I thought it was going to lock up already because there's less than $3.2 trillion in bank reserves out there. A whole bunch of representatives from different banks as to why they weren't utilizing the repo facility more. That because what they're doing is their banks are borrowing at higher rates from other banks than the Fed is offering on repo. And then John Williams is like, why are you doing that? Why are you paying more when you could just come to me and I'll give you the cash? And they're like, basically, well, it looks bad if we do that, and we don't want to come to daddy, for money, because then it makes us look really weak, and then other banks charge us higher interest rates because they don't trust us. So the only way they can make the repo facility more attractive is by forcing everyone to use it, so everyone's on an equal playing field. I think they'll probably try to do that. But anyway, the fact that there are repos going on now, even if they're small, means that they're out of cash. There's no more cash. So something is going to buckle, whether it's somebody leveraged in the Bitcoin market, somebody leveraged in NVIDIA. Since the cash isn't flowing anymore, something is going to cause a margin call somewhere else, and everything's going to start falling over very fast. Remember, Silicon Valley Bank was fine one day, and the next day it was gone. So the same thing's going to happen this time. It's going to be some other catalyst, some other bank, some other institution, but it's going to happen pretty soon. Once you start an inflationary system, the only way out of it is more inflation. And at some point you have two choices. You either keep inflating until the currency dies, or you stop inflating and let the banking system die. But you can't have both in a fiat system. It eventually falls over. So we're coming to the point where we're going to have to make a choice. And as you get closer to that end point, you have every time you have more of a violent choice. Either it's extreme deflation and a whole domino that goes back to 1971, or it's extreme hyperinflation and we're back to 1971 anyway. So it just depends which path you want to take. Now, I think the obvious path is hyperinflation. People have this idea that, well, it's the dollar and it's the whole planet, and they know what they're doing, and they'll figure out a way without hyperinflating or without hyperdeflating. There's got to be some kind of middle path where they can figure it out. We haven't figured out how to break the laws of economics. We haven't figured out how to break the laws of finance. We haven't even figured out how to break the laws of gravity or anything else. We can make it seem like we broke the laws of gravity by, going in a plane and then diving really fast, so it looks like we're floating in the plane, but really that's just diving. It's not breaking the law of gravity. So you can look like you have control of a fiat system for a while, but it's really just going like crazy in a plane and making it look like there's no gravity. But there's gravity. It comes back. It's always there. So we're not going to break the laws of nature this time. It's not happening, and the things are going to go back to the way they were before 1971. So Japan is as perfect of an example as we can get for when Keynesianism breaks down, when there's an inflection point and it no longer works, right? The whole Keynesian system is dependent on higher interest rates. Means you strengthen the currency, means you slow down inflation. Like the way Walter Block, I remember, puts it, he says, Professor Walter Block of Loyola University, he's in the Mises Institute, or he was. He says that Keynesians believe the economy is like a car, right? You hit the brakes by raising interest rates, and you hit the gas by lowering interest rates. So that works as long as the main owner of your bonds, of your government's bonds, is not the central bank itself. So if let's say the main holders of the government's debt are private companies or just anyone but the central bank, so if you raise interest rates, that would strengthen the currency, all other things being equal, because higher interest rates means higher savings rates, so that encourages people to save and spend less. If you encourage us to spend less, that means prices will go down, because the demand for holding money itself, as opposed to spending money and getting rid of it for other things, goes up. So in that situation, you're strengthening your currency, you're raising interest rates, you're hitting the brake on the car. But in a situation like Japan, it's the inverse. Why is it the inverse? Because the biggest owner of Japanese government bonds is the central bank itself. So therefore, when you raise interest rates, what happens to the central bank? Its balance sheet loses value, because when you raise interest rates, you're pushing down the value of the bonds, and therefore your central bank goes into losses. But the currency is the liability unit of the central bank itself. So at that point, where Japan is right now, the higher interest rates go, the lower the yen goes. You can see this on a chart going back like 5 or 6 years from the point where the inflection point started. The yen has been falling as Japanese interest rates have risen. Not perfectly. It's not perfectly correlated, because you still have people and traders that are human that still believe in the Keynesian principle, but nature overwhelms it. So what I'm saying is Japan can raise interest rates and therefore hurt its currency, because the biggest owner of the bond market is the issuer of the currency itself, or it can push interest rates down and hurt its currency even worse. There's no way up for it. It's over. It's done for Japan. The mainstream will follow whatever's hot. If Bitcoin's hot, they'll follow Bitcoin. If gold's hot, they'll follow gold. So there's no chiddush there. There's nothing new there. To me, what's happening now is that gold, it's not that gold is consolidating, it's that the dollar is taking a rest, because now we're at a breaking point where, we're at either a deflationary moment or a further inflationary moment. We have to pick the course. So as long as the Fed hasn't picked yet, because it's barely hanging on with the short-term interest rates, and it's barely hanging on with this, and it's trying to give repos to try to stabilize everything. So as long as we're at the fork and we haven't taken a path, things are going to be volatile up and down. Gold has gone up $100 one day, down $100 the next day. Is it up today or is it down today? I don't even remember. But I think it's steady today, and gold stocks are diving because other stocks are diving, because Nvidia was a buy the rumor, sell the fact thing, and Bitcoin's diving, and that's probably causing margin calls in other places because people take out debt to buy Bitcoin. Who knows how much debt is stacked into Bitcoin? Nobody knows. So I think we're going to continue to be volatile, until the Fed picks a direction. And I know which direction they're going to pick. So it's just a question of waiting it out. And as for the dollar price, I'm not even going to say what it doesn't even matter. The question isn't what the dollar price of gold is going to be. The question is at what dollar price doesn't even, where are we going to be when nobody with dollars will give any will be able to buy any gold, because nobody with gold will want any dollars. So what's that dollar number where everybody with gold just says, stop, I'm not taking any dollars, I'm just gonna because I'm just gonna use this stuff directly, and then gold becomes money again directly. What number is that? I mean, I would guess maybe somewhere around 80,000, 60,000, 80,000. I mean, it depends how much money the Fed prints. If the Fed stops printing, it'll stop at 100% now, which is about 30,000. But I know they're going to print more, so it could stop at 60,000. And then, it doesn't even make a difference because the purchasing power is the same anyway, no matter what dollar number we end up at the end. It's all based on the imagination that the government can pay its debt. Which it can do in worthless dollars. That's possible. But then by the time you're paying back debt in worthless dollars, nobody cares if you're paying back debt because it doesn't mean anything. So that's where we're headed. But this is what Keith Weiner talks about this a lot, and I had an episode with him on my channel a few days ago. It's not like at the end of this, people suddenly come to a realization like, oh, yes, well, now we understand that gold is money, so therefore we will dump our dollars and go for gold. People are stuck in the dollar system because they have to be. That's why I still have to earn dollars, because I have all these bills to pay and they're denominated in dollars. But the moment that the value of the dollar loses value, the value of the dollar goes down so fast that all of my bills keep going up nominally so quickly that nobody cares about paying them anymore, and then everything just stops. Well, then I just stop paying my debts, and then the company stops providing its service, and then everything just stops, and then you have to use something else. So what are people going to use? Either nothing or money. So it's going to, in the immediate aftermath, it's going to have to be gold and silver coins. Like, there's going to have to be, in the very immediate aftermath of whatever this is going to be, there's going to have to be collector people that are knocking on my door and saying, give me the silver coins or we'll shut off your electricity. And initially, it's only going to be the people that have silver coins that will even have the ability to have electricity, because no one else will be able to pay anything. So that shouldn't last too long, because it shouldn't take too long for gold and silver to start circulating, right? And in order for these coins are like the electrons in the power plant, in the system that's moving negative charges where the electricity is going through the wires. If you have no liquidity moving through the system, everything stops until you find something that's liquid enough to move through the system. Derivatives don't work, so then you use the money itself, and I think that'll be like a few months until we get something going again. And then we can start this whole game over. And now you could see that as a separate phenomenon or a coincidence that they had an excuse to print like $4 or $5 trillion just a few months after the plumbing locked up. Or you could take a more conspiratorial angle and say it was planned, or they just had an excuse and they went with it. Whatever it is, I mean, they needed to print the money, and ever since then, from then until around now, there were no more repos provided by the Fed. I mean, repos provided by the Fed is when banks don't have enough cash to lend to each other, so the Fed has to step in and say, you know what, we'll provide the missing cash. So that was the case from about maybe like 2014 to 2019, like after QE3 ended, and they started shrinking their balance sheet for the first time. So there were repos in those years until 2019, and they stopped. Then they started again after the repocalypse, and then they stopped during the COVID printing until now. So now the Fed is providing repos again, not that much. And I just read an article on Bloomberg that there was an emergency meeting or a sideline meeting between John Williams, head of the New York Fed, and I don't think that central bank accumulation of gold is relevant. I'm not saying it has no effect. It affects the gold price because it's another buyer, but I don't think that central banks will be able to save any of their currencies by accumulating gold. And the example I just keep going back to is Turkey. Turkey has been the biggest buyer of gold. So the Turkish central bank they're up and down, but like lately, I think over the past 2 quarters, they've accumulated a lot of gold. If you look at their gold reserves, but their currency is still on a hyperinflationary path. The value of it keeps going down and down and down. At a certain point, where you see this in countries that have already reached hyperinflation. I think we talked about this before. That why does hyperinflation take so long? It's because, like, imagine you're in a car and you have the gas floored and the brake floored at the same time. Right? So if we're in a dollar system, then the dollar, it's the fact that you can still use dollars and the central bank can peg at an artificial price to the dollar and cause shortages in its country by doing that. So people will end up in breadlines. So you can put a brake on your currency by using dollars instead. And then what you see is like a diagonal in the value of the currency as it wants to go up, it wants to go down versus the dollar, but the central bank keep pushing it down, like artificially, and causing shortages. So that's where Turkey is. If you look at the currency, the Turkish lira, right? It's on a diagonal. It keeps going up, meaning going down, against the dollar every day on the same curve. It's been doing this for like 4 or 5 years. And you'll see the same thing in Argentina, except when Milei was elected, like it devalued a little, suddenly, and then went back on that same diagonal, but with the same break. So what my point is, at the end of all this, is that central banks can accumulate as much gold as they want. Nobody trusts them anymore. So if you're not going to openly say, I have this much gold, central bank X says, I have 1,000 tons of gold. Now everyone with my liability units can get this much gold. If they want, here's the window, come at 5 o'clock and we'll give you gold for whatever currency units you have. No central bank is going to do that.